first tick that we're getting on the index this morning. It's down about 78 points.
Firmly down day for our markets, 19,750, 150 points lower.
Turning out to be a session where we are seeing that pressure, which is relentless, you'd have to say, for the financials.
Absolutely no respite. We're at 19,732. We'll end at what, 19,746. The level which we put out at 230, I think is defended. So 723 is the 50% retracement. We'll end at about 746.
Hello and welcome to Markets Today, the show we track around 6 hours of the day's trading action in just 5 headlines. I'm Nigel D'Souza. Let's get straight to the headlines for the day. Stocks tumble for the third straight day, with financials being the big drag. Sensex loses 600 points, Nifty falls 150 points. All sectoral indices close in the red with cuts of up to 3%. The rush of share offers continues, with the centre looking to divest up to 4.92% in SJVN at a floor price sharply lower than yesterday's close price. Sheela Foam floating a QIP to mop up funds to the tune of nearly 1,200 crore rupees. Apollo Tyres slips after worker trouble at its Gujarat unit leads to a halt in production, but MCX gains on its plans to shift to the new trading platform by the month end. Stock decline across the world after the US Fed holds fire but signals that higher rates could stay for a lot longer. Crude oil prices fall further after the Fed decides to hold rates and ahead of the policy moves for the central banks of Indonesia, Philippines and England. Brent trades above the $92 per barrel mark. Well, to the first headline then. Stocks tumble globally after the US Fed decision on rates. The Nifty and the sensex, well, they fell for the third straight day to end with cuts of around 1%. The Nifty remained firmly below the 20,000 odd mark. The banks, they took it on the chin. The index was an underperformer yet again, down 1.5%, while the mid-caps fell in line with the blue chips. The BSE companies erased a market capitalization of 2.5 lakh crore rupees. Prashant Nair joins us to fill us in with all of those details. Prashant, over to you.
Well, we started with pretty negative global cues with, the US indices lower, the dollar higher, yields popping up, and all of that showed up as we started. So the market ended lower and then it lost a little bit more. At no point did it see that it seemed that it was going to recover, or there was no attempt at a big meaningful bounce, and it stayed down through the course. The Bank Nifty, much larger loser there. I mean, almost double the losses as compared to the Nifty. Almost, 750 odd point cut on the Nifty Bank. Mid caps and small caps, the small cap in this index and small cap space has had a much larger run on the way up. And for the last 3 days that the market's been pulling back, small caps have been pulling back more. So more to give back there. Now, cuts coming through on the Nifty index in the form of Mahindra & Mahindra. ICICI Bank banks, as I said, were the big reason for the fall. SBI, IndusInd were the other banking names. Cipla and Ultratech were some of the other large cap stocks which came under pressure. Some gains, you had Adani Ports, which ended higher, Tech Mahindra, which was up, and Dr. Reddy's Laboratories, which also ended in the green. Broader markets, one way in terms of advances to declines in favor of declines today, of course, almost 4:1. SJVN, big cut there. Central Bank, UCO Bank, Indiabulls Housing Finance back under 190. NHPC, Panacea Biotech, KPIT, Balrampur, ICICI Pru. There was Chennai Petro, Gokuldas Exports, which has been such a big winner, also came under pressure. Some gainers in the form of Nava. There was Sirma, which was higher, and there was Senco, which is the recent listed player from Kolkata, the jeweler, which ended marginally in the green. This is a bit of a global pullback that we are seeing, in addition to the fact that the market in India had done amongst the best in the world. So there is that element as well. But I think from the global arena, repair will come in the form of lower crude prices. We saw some of that yesterday, a little lower in terms of dollar, and yields which have been pushing higher across the curve in the US, which also needs to settle down. Back to you.
Thanks a lot for that, Prashant. Well, in market opinion, Ajay Srivastava, CEO of Dimensions Corporate Finance Services, believes that high interest rates in the United States don't do well for India. He also lays down his top sectoral bets. Let's hear him out.
high interest rate in the US don't do well for India at all. And I think at multiple levels, one, Indian interest rates have to remain much higher. There's a pressure on rupee which will keep coming into place. And the fact that interest rates are high in the US means that they are low on unemployment at that point of time, and which is what is true. They're one of the lowest historical unemployment rates compared to Indian situation. So I think by and large, I think there's a consensus, at least for Indian markets, that high US interest rates don't work for us. India has got three spending stories: railways, defense, infrastructure. Those three stories are what is going to play out for Indian investors because these are the kind of contracts which run for multiple years. I would still say railways, and particularly MNCs which deal with railways, I think those are best places.
Well, moving to the second headline now. SJVN crashed close on 12% after the government launched an OFS. The government plans to sell close on 2.46% as the base offer and will retain oversubscription option of another 2.46%. Vivek Iyer joins us to fill us in with more details. Vivek?
Hydropower major SJVN is in focus and under pressure, given the fact that the government yesterday indicated its intention to sell up to 4.92% stake in the company, and the route chosen by the government to divest the stake is via the OFS route, or the offer for sale route. So out of this 4.92% stake, 2.46% is the base size, and another 2.46% is the option that the government has in order to go ahead and, if in case there is an oversubscription, the government can exercise that particular option. The floor price for this particular OFS is at 69 rupees a share, which is actually more than a 15% discount to yesterday's closing price. The government, remember, held 59.9% stake in the company at the end of the June quarter. SJVN, remember, has been a stellar performer in terms of stock price performance. The stock is up 151% in the last 1 year, and from June lows, the stock has doubled. What is the reason for that? The outlook that the company has given has been quite strong, and power demand trends have been very strong as well. The company, remember, also recently upgraded its renewable energy capacity addition guidance to 7.7 gigawatts by FY26 versus the earlier 2.7 gigawatts that it had by the end of FY25.
Well, Vivek, stay with us. Sheela Foam as well slipped over 3%. We learned from sources that the company has floated a QIP to raise 1,200 crore rupees. Tell us more, Vivek.
Sheela Foam was in focus as the company has launched a QIP to raise up to 1,200 crores. Our sources indicate that the base size of this particular QIP is 1,000 crore, and the company has an additional option to raise a further 200 crores via the upsize or the green shoe option. The QIP indicative issue price comes in at close to 1,078 rupees a share at the lower end of the price band, which is over a 7.5% discount to yesterday's closing price. At this particular price band, there is a dilution of 11.4% of the total pre-issue equity capital of the company. Now, what we understand from our sources that out of the total 1,200 crores, 950 crores will be used by the company to go ahead and fund the proposed acquisition of Kurlan Enterprises. On the back of that, both Sheela Foams as well as the incoming company, which is Maharashtra Apex, were in focus in today's trading session.
Well, moving to the third headline today, Apollo Tyres tumbled close to 3% after the company announced a temporary halt of a couple of their tyres facilities at its manufacturing facility in Gujarat. Sonia is with us to fill us in with more details. Sonia?
Well, thanks a lot for that. Apollo Tyres is trading in the red today after its bias and OTR tyre production at the manufacturing facility in Limda, Gujarat has been halted. Now, this stoppage has happened because of concerns among the shop floor employees relating to the renewal of the long-term settlement agreement. Now, the company is in discussion with the labour union at this point in time, and they have said that there are plans put in place to mitigate any kind of supply disruptions. As of now, there's no material impact on the production at this stage, but they are not sure which way things could head. This is, of course, a very specific issue that Apollo Tyres is facing due to stoppage of its production of its plant. But otherwise, if you look at the longer scheme of things, Apollo Tyres, the stock has been moving up because demand has come back in a big way. Commodity prices have cooled off as well. And most brokerages are quite upbeat on the stock. In fact, Morgan Stanley has an equal weight rating with a target price of 425 rupees a share.
Got that. Thanks a lot for that, Sonia. Well, MCX gained close to 2.5% in trade after it announced its plans to shift to a new trading platform by the end of the month. The street read this positively. Well, Surbi joins us to help us out. Why exactly the street like that? Surbi?
Thanks so much for that. So MCX is on our radar today, and that is because they've issued a circular where they propose to go live on the new trading platform by the end of this month. Now they will be switching from the 63 Moon Technologies platform to the TCS platform, which was anticipated to be completed by the end of December, but this circular says that now it will be completed by end of September itself. They further say that they will issue a new separate circular where they will also give the exact date where the new trading platform goes live. They say that they have been conducting mock sessions since the beginning of September, and they have been doing fairly well on those mock sessions, and that is why the date could be moved ahead from December to September, and that is what the street is liking in MCX.
Got that. Thanks, Surbhi. Explains why the stock was a relative outperformer. Now, hospital stocks, well, they have been delivering very strong listing gains for investors on the large street of late. The latest company to join this IPO buzz list is Jupiter Hospitals, which listed at a premium of more than 30% over its IPO price. Ekta Batra is joining in. Ekta, what's leading to recent strong showing in hospital stocks?
Thanks for that. Well, yes, recent hospital IPOs have seen strong gains, rallying anywhere from 28 to close to 150% from their issue prices. Valuations too reflect these strong gains. Now, models specific to these hospitals that are tapping into India's low bed count of 0.5 beds to 1,000 people range from being a specialty place such as Rainbow, which is a pediatric hospital, to Dr. Trihan promoted Medanta, to core marketplace such as Kim's in the south and Jupiter and micro markets in the west. Their business models combined with growth drivers such as government looking to up the healthcare spend to 2.5% of GDP by FY25, increased awareness amongst patients post-COVID-19, advancement in surgical procedures, increased medical tourism are making analysts bullish on their earnings. Estimates are that in the next 3 years, the EBITDA CAGR could range up to 20% for a few of the newly listed hospital companies, including the impact of dilution from expansion plans that they have. This EBITDA growth is now expected to be aided by improved occupancies. For example, Yatharth is expecting their occupancies to inch up to around 60%, while the newest listing, Jupiter, is expecting their occupancies to scale up to around 80 to 85%. Now, higher occupancies as well as reducing inflation are expected to aid the overall average revenue per occupied bed, while Yatharth expects their ARPOBs to move by around 10% to 30,000 odd rupees. Companies such as Jupiter say they need to be sensitive of the geographic location. The street is estimating, however, 5 to 10% annual increase in ARPOBs on an average for hospitals. Also, companies are focusing on asset-light expansion, such as management contracts where break-even becomes faster and is more efficient from a cash return standpoint versus brown and greenfield expansion, which is more EPS dilutive. Lastly, while the market is factoring in strong earnings growth, which is reflective in the valuations, it is important to be cognizant of the risks, which include occupancies not picking up as much as anticipated and the regulatory risk, which could range from a cap on consumable prices to increasing caps for concessional treatment.
Interesting one, Ekta. Thanks a lot for that. Well, time to slip in a short break, but we'll be back with the other headlines that we're tracking for you. Don't go anywhere. Welcome back. You're tuned in to Markets Today. We'll get into the fourth headline then today. The two-day meet of the FOMC, that's a Federal Open Market Committee, concluded last evening, and the US Federal Reserve held rates steady at around 5.25 to 5.5%. That was on expected lines. However, the FOMC indicated that it expected one more interest rate hike by the end of 2023. And that's not all. It also pointed out that there will be fewer cuts in the next year. Well, despite the Fed's hawkishness though, that's what pushed up the US 10-year yield by around 10 basis points to around 4.35%. The Indian 10-year yield has risen by only around 1 to around 2 basis points. Likewise, the dollar index, well, it had risen by close to 70 basis points to around 105.5. The rupee though didn't see any big movement. Well, Lata's with us to analyze why this sort of action was so muted. Lata, over to you.
Well, the big chatter in the Indian bond and rupee market is the likelihood of Indian bonds getting included in the JPM bond index. So you can see the very muted reaction despite a 10 basis point rise in US 10-year yields. The Indian yield actually went up by 2 basis points, and towards close of trade, even that got mellowed to perhaps 1 basis point at the most. And the expectations stem from the fact that the announcement usually comes in the end of September, effective or the first week of October. And that's why as we get closer to the end of the month, the chatter gets louder. There isn't any new information, but people reiterate what they have been hearing. One, that the bond investors, funds which follow the index, when asked by the index providers around August, that letter went to them, they have responded overwhelmingly in favor of inclusion of India, and the chatter grew after China and Russia became practically uninvestable. The second reason is that JPM itself put out a report saying that now they're able to adjust and do the clearing for withholding tax. So they should be able to adjust other taxes, is the argument. And, you know, India has been under watch. You can't keep a country under watch for years. It's already over a year. So a decision has to come one way or the other. And at the moment, the India story is so strong that it would make more sense to include. That's what the market chatter is trying to convince itself. I want to repeat that there is no new information that has come from the index providers, but the market is simply so sure or getting increasingly sure that this may work in favor of Indian bonds, which is why we are seeing hardly any impact on Indian bond yields from an action that should have been extremely negative for Indian bonds as well. If nothing were to come by October first week, we can see a very big jump in Indian yields, maybe 5-10 basis points in the very least. But at the moment, the markets are in the grip of this expectation. Likewise, ditto for the rupee market as well. As you know, the dollar index has surged, but the rupee is barely weaker. Dollar is stronger by about 5-6 paise compared to the overnight close. And here again, besides this expectation, the traders tell us that Reserve Bank also has been providing dollars, selling dollars, and this is working to a double plan. It is smoothening the likely depreciation of the rupee. The Reserve Bank also wants to remove excess liquidity in the system. They have made that abundantly clear by the incremental CRR that they had announced. Now that that is going away, they're using other means to keep liquidity tight. And so this selling of dollar is working to Reserve Bank's overall game plan, is what traders tell us. But the important point is a lot of dollars is expected to come into the system if the index inclusion happens. That's another reason why the market itself doesn't want to short the rupee. So that's the big news in the bond markets, not the Fed, the bond index.
Okay. Well, we hope that comes through finally, Lata, but good to see a relative outperformance from our bonds as well as from the money market on the whole. Well, moving to the fifth and the final headline today, crude oil prices, well, they fell further after it hit its lowest levels in a month in the previous session. This, as the US interest rate hikes, offset the fall in the US crude inventories. Despite leaving rates unchanged, the Fed stiffened its hawkish stance with a further rate increase projected by the end of this year. Manisha Gupta joins us to fill us in with more details. Manisha?
Well, yes, second straight day that too, and we've seen the crude oil prices move away from 10-month highs to almost a 1-month low in the international markets right now. So after almost touching a $96 a barrel on the higher side, we've come below 93 right now. And as you pointed out, the higher interest rate prospects post the Fed decision on has led to some profit taking coming in for the crude oil prices. It has been overbought. We've seen 10% of gains in crude prices in last 1 month itself. And if you look at the chart in last 3 months, we've seen prices gain up by 30%. The support, though, could continue because the US inventories have seen a decline yet again. There also are reports on declining inventories in major markets also. And then there has been an EIA report suggesting that the US oil output for the month of October could see a decline for a third straight month. And you could see that number come to nearly 9.4 billion barrels per day. There also is the fourth quarter deficit that the street has been working with. The reason in the first place that you saw such rush in case of crude oil prices. And just to tell our viewers, there are 160 varieties of crude oil. And while we have seen all of them surge up in last 1 month or so, a couple of them already have hit $100 a barrel. This is from Nigeria and Malaysia that we've seen the crude prices continue to run up. And that's exactly what the near-term and medium-term forecast comes in as. JP Morgan says that $120 a barrel also is a possibility in the fourth quarter of this year because of the tightness that you are expecting going forward. Saxo Bank has talked about crude headed or making an average of $94 per barrel by the end of this year. Probus Securities had talked about $100 a barrel as well. We also have seen Goldman Sachs talk about 105. Fat Profits has given a range anywhere between 90 to 95. Bank of America says that they look at crude prices averaging at $90 a barrel. And then Wood Mackenzie's talked about 88. UBS has been telling its clients to take some profit taking above 95, but they also believe that $95 a barrel is where this year could end up as. So even as we are looking at a 1 month lows and some profit taking coming in, the medium term, the fourth quarter expectation in sense of crude oil prices is still on the higher side.
Thanks a lot for that, Manisha. Well, on that note, though, we'll have a wrap up on this edition of Markets Today. You stay tuned for more news and updates.